All right, welcome to The Explainer. Today we're digging into why Bitcoin recently took such a massive hit. Now, you might think the answer is buried somewhere in the code or on the blockchain, but you'd be wrong. The real story is found in the world of oil tankers, geopolitical conflict, and something called a global liquidity squeeze. So let's just start with this idea, this quote that really flips the whole story on its head. It suggests that during a major crisis, Bitcoin's most important feature isn't its tech or its potential as digital gold. Nope. It's the fact that it's always on. But how on earth can chaos in the oil market force the hand of crypto traders? Well, that's exactly the mystery we're here to unravel. So, how are we going to connect all these dots? Well, here's our game plan for today. We're going to break down this Bitcoin ATM theory. Then we'll look at the oil shock that lit the fuse, connect it to the plumbing of the financial system, weigh the conflicting evidence, and finally, try to figure out what the new rules of crypto really are. Okay, so let's get right to the core of it. What if I told you that the recent Bitcoin crash had almost nothing to do with, well, with Bitcoin? That's the central idea behind the Bitcoin ATM theory. It argues that the massive sell-off wasn't about people losing faith in crypto. It was about a desperate, frantic need for cash somewhere else in the global economy. Here's how it plays out. Let me paint a picture for you. Imagine you're a big institutional trader. You've got a massive bet on, and suddenly, the market just turns violently against you. Your broker is on the phone screaming that you need millions of dollars in cash right now. That's a margin call. So you look at your portfolio. Stocks? Nope, market's closed for the weekend. Bonds? Too slow to sell. But your Bitcoin? Oh yeah, you can sell that instantly. Any time of day, any day of the week. In that moment of sheer panic, Bitcoin isn't an investment. It's your personal global ATM. So that's the theory. But what kind of event, what kind of global catastrophe could possibly trigger a worldwide cash scramble that big? Well, it all starts with a geopolitical fire in one of the most critical parts of the world. In early 2026, things went from bad to worse incredibly fast. It started with targeted airstrikes, but it spiraled, and I mean spiraled, into a full-blown blockade of the Strait of Hormuz. We are not talking about a minor traffic jam here. This was like someone clamping shut one of the main arteries of the entire global economy. This was the single biggest shock to the world's energy supply in almost half a century. And the market's reaction? Pure, unadulterated panic. The price of Brent crude oil, the global benchmark, just shot past $120 a barrel. Now, if you're a trader who had bet on prices staying low, if you were short oil, you're not just having a bad day. You are in a world of hurt. Your bet just exploded in your face, and the bill you now owe is astronomical. Okay, to really get how insane this was, we gotta talk about two weird-sounding words: contango and backwardation. Just think of them as two totally opposite kinds of market panic. This recent crisis was backwardation. That's a scarcity panic. Everyone is screaming, I need oil right now and I will pay absolutely anything to get it. It's the exact opposite of what we saw during the pandemic. You might remember this from the COVID lockdowns back in 2020. The world was in contango. There was so much oil and so little demand that we literally ran out of places to store it. It got so crazy that, for a moment, sellers had to pay buyers almost $38 just to take a barrel of oil off their hands. The 2026 crisis we're talking about today, it was the complete polar opposite of that problem. Not nearly enough oil and desperate buyers everywhere. All right, so we've got the spark, a geopolitical powder keg exploding in the oil market. But how did that fire jump all the way over to the crypto world and cause a Bitcoin crash? Well, the answer is hidden in the financial system's plumbing, which, it turns out, was already leaking pretty badly. You see, the groundwork for this whole mess was actually laid years before. After more than a decade of pumping money into the economy, the U.S. Federal Reserve started doing the exact opposite. It's a process called quantitative tightening, or QT. The easiest way to think about it is that the Fed was using a giant vacuum cleaner to slowly suck cash, or liquidity, out of the financial system. So money was already getting tighter. And if you want hard proof that cash was getting scarce, just look at the repo market, which is basically a high-stakes pawn shop for big banks. A key part of it, the Fed's reverse repo facility, which is essentially the system's rainy day fund, well, its balance collapsed from a massive $2 trillion down to just $2 billion. The emergency cash reserves were pretty much drained before the emergency even started. And then, bam, the oil shock hits. all those traders who were short oil were suddenly facing a financial doomsday scenario. Their brokers hit them with margin calls, demanding they come up with enormous amounts of cash immediately to cover their losses. For them, it was a complete nightmare, and they needed money right now. So you can see the dominoes falling, right? 1, the oil shock hits. 2, that triggers massive margin calls. 3, the traders scramble to find cash, but the whole system is already dry because of QT. So what's the 4th and final domino? They have no choice but to start selling anything and everything they own that can be turned into cash in a hurry. And this chain reaction leads us right to Bitcoin's doorstep. For years, we've all heard the story, right? Bitcoin is a safe haven asset, it's digital gold, it's a hedge against chaos. But when the chips were down in this crisis, was it a fortress protecting investors, or was it just another hostage? Well, on the surface, the hostage theory looked pretty strong. Some analysts started throwing around this number, 0.68. That was the correlation coefficient between Bitcoin and oil. Now, just to put that in perspective, a correlation of 1 means two things move in perfect lockstep. 0 means there's no connection at all. So 0.68, that's a pretty strong statistical link. And it suggested that as the oil market was going haywire, Bitcoin was being dragged right along with it. But hold on. As any good analyst will tell you, correlation is not always causation, and a single number rarely, if ever, tells the whole story. Within the crypto community, people were looking at the exact same data and coming to a completely different conclusion. They were basically saying, nope, you've got this all wrong. Yeah, researchers from Binance pushed back, and they pushed back hard. They claimed that 0.68 number was the result of a classic statistical mistake. The problem, they said, was that the analysis used prices instead of returns. Think of it this way. Using prices is like comparing the total distance two cars have traveled. What you really want to compare is their speed at any given moment. That's what using returns does. And when the Binance team compared the speeds, they found no real connection at all. In fact, they pointed out that in the initial phase of the crisis, Bitcoin actually went up 15%, suggesting it was, for a short time at least, acting like a hedge. But you know what? Maybe this whole debate about statistics completely misses the most practical, important point. The key factor here might not be correlation, but access. When you're a trader facing financial ruin, you don't have time to think about economic theory. You sell what you can sell. And when that margin call hits you at 3 a.m. on a Saturday night, the New York Stock Exchange is dark, the bond market is closed, but the crypto market, it's humming along. It is the only ATM on the planet that never, ever closes. So, what have we learned from all this? This event wasn't just another volatile swing for crypto. It revealed a new and, frankly, brutal truth about Bitcoin's real place in the global financial system, especially now that the big traditional players are in the game. And here it is. This is probably the single most important takeaway from this entire episode. In the current system, crypto assets, especially Bitcoin, function as a global liquidity sponge. And here's how that sponge works. During times of easy money, when central banks have the money printers going and cash is cheap and plentiful, that sponge just soaks up all the excess capital. That's when prices go to the moon. But when a crisis hits somewhere else, like the oil market, and those big players desperately need their cash back, that sponge is the very first thing they wring out. The liquidity flows out just as fast as it flowed in. So this event really challenges that whole digital gold narrative. In this crisis, Bitcoin behaved exactly like a speculative, high-risk tech stock. When fear took over and liquidity vanished, investors treated it as a source of cash, not as a store of value. And this is the brutal truth for its biggest fans. As Bitcoin has become more integrated into the traditional financial system, it's also inherited some of its vulnerabilities. It is no longer on its own isolated island. And this leaves all of us with the critical question for the future. As the financial world gets more chaotic and interconnected, what is Bitcoin's ultimate destiny? Will it finally mature into the independent safe haven that its supporters believe it can be? Or will its 24/7 liquidity always make it the system's go-to emergency ATM destined to be drained every time a real crisis hits the traditional world?